All right, welcome back from the break. We're going to start and do principles of asset allocation, real world constraints. And then the last part of the day, we'll do option strategies. Tomorrow, on a Friday morning, we'll wake up bright and early. We'll do futures and forwards and swaps, currency risk management before lunch. So it'll be a fun-filled Friday morning. So, the memory palace for asset allocation. If you come into an asset allocation, I want you to think about maybe I have on like a little hat. And around my hat, I have these Christmas ornaments hanging, these different balls. And so these various balls that are in front of you on the hat, I want you to think of it in the context of the first decision process that you have in asset allocation is asset only versus asset liability. Okay? Asset only becomes mean variance optimization. It can incorporate Monte Carlo. It can be goals based. Okay? Every sub portfolio in goals based is mean variance optimized. Now, under the liability driven approach, you build a portfolio of assets, predominantly bonds, that mirror the behavior of the liability that you have to pay. There is no asset optimization. It is based on, can I achieve the realized return that it requires to retire the liability? So asset only, asset liability, okay? So when we talk about asset only, the biggest topic is mean variance optimization. And whenever I say MVO, I need you to think about bum, batum. And the batum is the Sharpe ratio. So the Sharpe ratio says, I have a risk reward trade-off, which is what mean variance optimization says. Mean return variance risk. Mean risk variance return risk trade-off. And so what the computer model does as an algorithm is it says, I'm going to create an axis. And right here at the center of the axis, I have a zero risk asset and its risk-free return. And as I move down if I move down from the zero risks to high risk, I start introducing various asset classes that provide returns. But at some point in time, if I start adding so much risk, the returns start to minimize. And that's why we get kind of a concave mean variance efficient frontier. Okay. So it's all about the risk reward trade-off with the Sharpe ratio. Okay. Now, there are two different ways to do MVO. The first one is not used very often. It's called the unconstrained, developed by Fisher Black. And it says I can have any asset class weight that I want. Now, when I start talking asset class weights, I want you to expand your minds, because an asset class weight isn't just a positive weight, meaning 30% on an asset class. It can be a negative weight. I've shorted the asset class. Or I can have zero. Those are three different choices. Positive weight, no weight, negative weight. Okay, so an unconstrained MVO takes all three possibilities. Well, that ends up with a crazy mean variance optimization. So we can't short Japanese real estate. So we got to put some constraints on it. So for the average client, a constrained MVO, the most common, is where we say we can either have a zero weight, meaning it's not in the optimization because it's not a permissible asset class based on the IPS, or it's a positive weight. So zero or positive. Okay. Now, here's the twist. If I say zero or positive, I'm implicitly saying non-negative. Non-negative means I didn't make that third choice. I made either a zero weight or a positive weight. So when you see the phrase non-negative, it says I don't have negative weights, non-shorting asset classes. Okay. Now, if you remember a moment ago, I was talking about the Tobin two-fund separation theorem. And I said, you have a choice between putting the weight in a risky asset class and the weight in a risk-free asset class. And we went through that exercise. And it was all built on utility theory. Well, now it says mean variance optimization requires three inputs: return, ta-da, risk, ta-da, and the correlations. The objective function is expressed as follows. You need to memorize the objective function. It is a really important equation. And it says, my utility as an investor is tied to the return risk trade-off and my risk aversion to risk. So I'm going to take the expected return of my asset mix, RM, and I'm going to subtract a risk penalty. And that risk penalty has a scaling factor, a negative 0.005, times lambda, which is my risk aversion coefficient, which can be on a scale of 1 to 8, 1 to 10. The higher the value, the more risk averse, lower risk tolerance, greater risk penalty, the last part of the equation has, times the variance, sigma squared, of that asset mix. So if you have somebody that says, hey, just give it to me, they'll look at an asset mix, they'll put the expected return, and then they subtract what's called the risk penalty. And they say, well, if my lambda is near 1, low risk aversion, high risk tolerance, then what's going to happen is that risk penalty that's subtracted from the return is going to be very low, which means that I achieve a high amount of utility from the high expected return and my irrelevance to the risk. Now, the scaling factor. We have to look at this. It says right here, the value of 0.005 in equation 1 is based on the assumption that the expected return and the standard deviation are expressed as percentages rather than decimals. So using the equation 1, omit the percentage signs. So in equation 1, do not put in a percentage, put in decimals or use whole numbers. So it says, for example, if the quantities are expressed as decimals, the 0.005 gets changed to 0.5. So if these, it says, therefore, if the expected return is 0.1 for 10%, and lambda is 2, low risk of high risk aversion, low risk tolerance, or I'm sorry, lambda of 2 would be high risk tolerance, low risk aversion, and the standard deviation is 0.2 versus 20%. Then when you crunch through the numbers, you put in 0.10 for the return minus 0.5, not 0.0005, times the lambda of 2 times 0.04, because remember, it's variance, not standard deviation. That scaling is very important, that you get the right number. So in this case, then the utility is 0.06 or 6%. Now, that's a white text example right there. Then what's going to happen is, if you come down into blue box number 1, Amy Goddard. Amy Goddard's been in the curriculum for 20 years. She and I have been long-term friends. I mean, this example's been in the curriculum since 2007. Long time. 2009. I was off by 2 years. So this is the deal. Amy Goddard is recently inherited 1.2 million with an above average risk tolerance with a lambda of 2. She's young and her goals is to fund a comfortable retirement and wants to earn returns that outpace inflation. Wait a second. Charmaine, what other reading do we look to asset classes that either keep pace with inflation or outpace inflation? Do you remember?
Asset allocation to alternatives.
It is asset allocation for alternatives. We look for a correlation coefficient between various pairwise asset classes with inflation that actually grow faster than the inflation rate. So Treasury inflation protected securities, they only match the rate of inflation, right? Where there are certain other assets like equities that outpace inflation. That's an asset allocation to alternatives. Goddard, who expects to liquidate, and this is key, 60,000 of the inherited portfolio in 12 months to fund the down payment of a house. So just scratch down